Hello and welcome to the lecture video. In this lecture video, we're going to talk about payback period and accounting rate of return, some simplified approaches to capital budgeting, and also quickly wrap up our discussion of IRR and NPV, which we talked about in some other lecture videos. Okay, so as we were talking about in the other lecture videos, the time value money techniques, internal rate of return, and net present value are applicable to many different types of long-run decisions. I gave you the example of pursuing an MBA full-time, and you would want to use net present value and or internal rate of return for your decision to pursue an MBA full-time. Some other decisions that a company might run into in which they should use NPV or internal rate of return would be something like outsource grounds maintenance, drop a product line, decision of whether to buy rather than make a product, advertising. Also, if we think about Mary Washington, the decision to invest in a new software package that improves registration, for example. That would be another example of a long-run decision in which Mary Washington should use net present value and or internal rate of return techniques. Okay, so let's talk about some more simplified approaches here to capital budgeting. And so the first one, I'm going to talk about the payback. And the reason that they're called simplified approaches to capital budgeting is because they don't consider the time value of money. Okay, so payback basically tells us how long does it take us to recover our initial investment in terms of months, in terms of years. So for example, if we have let's say for example that it cost us $10,000 to get an MBA in tuition. And what we have is the difference in our salary between having an MBA and not having an MBA, post MBA versus pre-MBA is $5,000. Okay, so the cost is $10,000. The difference in salary is $5,000 a year. It would take us 2 years to recoup our money. So the payback would be 2 years. So in order to calculate payback, we just take our investment required divided by our net annual cash inflow. So if we look at this example on this page, it says we have our Sunny Valley Wheat Cooperative is thinking about constructing a new silo. It costs $55 to make the silo. The payback period is $10,000 a year. Take our $55,000 divided by our $10,000, which means we pay for the silo in 5.5 years. Okay? So payback is going to be expressed in terms of time. You could go 5.5 years, or you could say 5 years and 6 months. Could just be in months. Okay? But it is expressed in units of time. So let's look at our next problem right over here, our Myers Company. Myers Company wants to install an espresso bar in place of several coffee vending machines. Okay, the company estimates that incremental annual revenues and expenses associated with the espresso bar would be, here's our sales, less our variable expenses, gives us our contribution margin. And we have is our insurance, these are other fixed expenses, salaries, and then we have depreciation. Equipment for the espresso bar would cost $150,000 and have a 10-year life. The old vending machines could be sold now for $10,000 salvage value. Okay? The company requires a payback 5 years or more. So this one gives us a payback requirement. So if our payback is less than 5 years, then we should take the investment just based on payback. If the payback is more than 5 years, it's not something we should do because it takes us longer to recoup our money than our desired time. All right. So if we look over here, the first thing that we have to do in this problem is we need to figure out the cash. We have to figure out our expected cash inflows. So if we look up here, I gave that to you at $10,000 a year, our expected cash inflows. In this situation, we need to figure out what our expected cash inflows will be. Now, we can assume this is all cash inflow, cash outflow, contribution margin, our sales minus our variable expenses, gives us our net cash inflow, and then we're paying cash for insurance, cash for salaries. That's what we can assume here. Depreciation is something we need to think about, though. If you think about what the journal entry for depreciation is, remember it's debit depreciation expense, and I'll just do it for $15,000 over here, and then it was a credit to accumulated depreciation for $15,000, okay? There's nothing to do with cash here. No increase to cash, no decrease in cash. Depreciation is a non-cash expense. It's a non-cash expense, okay? So what we have to do is we have to take depreciation out of the equation here, so to speak. And there's a couple different ways we can do this. And this is the way that I'm going to take it. I'm going to take my net operating income of $20,000. And then what I'm going to do is I'm going to add back my $15,000. And then what that's going to give me is my $35,000, which is my net annual cash inflow. Okay? That is my net annual cash inflow. Come back over here. That's my $35,000. Okay? And then what we said, we looked on the prior page, it said our investment in the espresso bar was $150,000. But the thing is that we can sell our existing espresso machines for $10,000, which means that we need to really add or increase our cost by $140,000. We have to pay net another $140,000 because we can sell our existing for $10,000, which means we have to add another $140,000. So this is the number that we really want to use for our investment required. We think back to the formula. We take our investment required divided by our cash flow, and that gives us our years. 140,000 divided by our 35,000, which gives us 4 years. That gives us our 4 years. Now, based just upon payback, we should take this investment. Why? Because remember, our payback requirement was 5 years. We did it we're paying it back in a year less, 4 years. So this is something that we should do. Okay? Just based on payback. The problem with only using payback is it suffers from 2 basic problems. The first one, I'm going to jump down here and talk about the second one first, just because it's easier to understand. It doesn't consider the time value of money. So we didn't do any discounting here. We didn't look up in any tables to figure out what the factor was. We didn't do that. It does not consider the time value of money. All right, so it doesn't consider the fact that we need to put our cash inflows and our cash outflows both on present value terms to really have an apples to apples comparison. It doesn't do that. So that's partly why it's more of a simplified approach. The other thing is it ignores cash flows that occur after the payback period. So let's suppose that we have a company is considering 2 investments. So I'll say investment 1, investment 2. Okay? And each one costs $1,000. The first investment gives cash inflows of $500 for 3 years. So I could say this is our 1,000, gives me 500 cash flow, right? Gives me a 2-year payback. It's a 2-year payback. Okay? The second investment, though, I'm going to say period. The second investment yields no cash in the first 2 years. So period 1 and period 2, cash flow is 0. Period 3, we have $1,000. So what is the payback? It's 3 years, because that's when we recoup that $1,000. But the other thing about this second investment, right, is it gives us a positive cash flow of $4,000 in the 4th period, in the 4th year. But the thing is if we only look at payback, we would go with this one, right, because it has a shorter payback, and we wouldn't do this one, although this one may have a higher net present value because you've got this big $4,000 of net cash inflow coming in period 4. Okay? So that's what I'm saying, is that if you just look at payback, it ignores those cash flows that occur after the payback period. So in this case, Payback was 3. We didn't even worry about this one, and we would have chosen this investment anyways because it had a lower payback of 2 years. But this one actually may have a higher net present value because you've got this big $4,000 cash inflow coming in period 4. Okay? So if we continue on, when we look at the accounting rate of return, I'm just going to talk about this one very quickly. The accounting rate of return is based on our accounting definition of net income. Okay, so the way that we do that is we take our average net income divided by our average investment, and the way we calculate our average investment is it's equal to our initial investment divided by 2. Okay, now I'm not going to test you on accounting rate of return, so that's all I'm going to talk about. It's just another way to evaluate it. I focus on payback period, net present value, and internal rate of return in this class, not the accounting rate of return, but I think it's useful for you just to know at a very high level what it is, okay? So the way we calculate that is we take our average net income divided by our average investment and divided by 2. And that can be used to evaluate investment opportunities by comparing their accounting rate of return with against our required rate of return. So obviously if our accounting rate of return is higher than our required, it's something we should do. If it's lower, it's not something we should do. Okay? So now we can look at the next page. We can look at the next page and we can have some concluding remarks here about our different capital budgeting methods. We have our payback, where the measurement basis is cash flows. With accounting rate of return, we're not looking at cash flows, we're looking at net income, which is based on accrual-based accounting, right? Net present value, we have cash flows and then cash flows. And then in terms of the strengths, the payback is easy to understand. Net present value reflects the time value of money. Internal rate of return, the time value of money. I'm just hitting the highlights here. In terms of some limitations of the payback, it ignores the time value of money. So does the accounting rate of return. And this one ignores cash flows that occur after the payback period. The net present value can make it a little bit difficult to compare dissimilar projects because they can have very different cash flows, and so it can make it difficult to compare. And then also with the internal rate of return, it could ignore any kind of different risks over the life of the project. When we come down here and we talk about some conflict between performance evaluation and capital budgeting, what we're saying is that you could have some managers who may be discouraged from using present value techniques for evaluating because of the way that their performance is evaluated. So for example, let's consider an example that has an investment has high amounts of depreciation in the early years, and it also has low revenues in its early years. What does that mean for net income? It means that net income is going to be very low in the early years because you have high depreciation, which is an expense, low revenues, so you're going to have low net income. But revenues may be later on, some cash inflows later on in the project may be high enough that it has a positive net present value. The problem, though, is that if you evaluate the manager based upon net income, they're not going to take the project because this project has low net income because of high depreciation and low revenues. So if you evaluate them based upon net income, they may not want to take the project even though it could have a high net present value. So that's when we're talking about the conflict here between how you evaluate your managers in capital budgeting. If you don't take into account some capital budgeting measures such as net present value, internal rate of return, then people may not follow that. Okay? And so some possible solutions for getting around this: evaluate managers on current profits, but then also take into future benefits. Okay? Or you could require some managers to own stock in the company, which is frequently does happen through stock options. And what that does is it makes them not just an employee, but also an owner of the company. And so they may be more inclined to take actions for the company that benefit the company over the long term, not just maximizing short-run profits. But it also depends upon how you set up that compensation scheme. Okay? The next series of lecture videos will cover managerial decisions. Thank you so much.